Hello and welcome. In this video, we're going to talk about getting started in real estate. Specifically, I'm going to provide some tips that I think are going to really benefit you early on in the process to make for a more enjoyable and ideally successful outcome. I've had the opportunity to help a number of clients with their first-time home purchase as well as subsequent investment property purchases, and we've learned a thing or two along the way. My name is Rick Vazza. I'm a certified financial planner and president of Driven Wealth Management, a San Diego financial firm where we work with driven professionals and entrepreneurs and help them create and maintain generational wealth. So as we dive into this, I think it's actually helpful to use a little bit of my own experience. I had primarily been helping other clients with their purchases up until February of 2019, where I went through my own purchase with my wife for our first time. And I wanted to highlight a few of the things that we did that I'm really glad we did beforehand that made us feel a lot more comfortable going through that process. So the first thing is, before even thinking about how much house can I afford and digging into all the details that you would traditionally do with a financial planner like me, I want to go even before that. Like, the very first thing is just understanding your market. And we moved to San Diego from the East Coast and really didn't know too much beyond the different neighborhoods in the area. So the first thing that I did is actually attended a real estate seminar that was put on for free through meetup.com. So very easy. This is something that you'd have access to as well. Here's Meetup. So with Meetup, it was very easy. And again, this happened for free. Just literally plugged in real estate, San Diego. You're going to get a dozen of different hits that pop up. And what I did is I just looked at what were some of the highly reviewed sessions, as well as which community had a lot of members that were engaged. And ultimately, I found one that looked promising, had great reviews, and also the host offered free beer and pizza as part of the informational session. So figured worst case scenario, get a nice night out of it. Best case scenario, I'd learn some really important things about the real estate market. And the agent, Patrick, who put this on, really did a phenomenal job. So I attended, and I was really impressed. I mean, like me, as I'm doing with this video, he led with education first. So he really wasn't making it a giant sales pitch. He was informing us, the new potential buyer, of how the market, was evolving and the different dynamics and trends that were important to be monitoring along the way. Obviously, his goal was to pick up a few clients, and it worked. He really impressed me, and I was glad to work with him later. But I think it was important to go into that session with an understanding of, I know, of course, he has an agenda and he's looking to, pick up clients, but it was very helpful that he was leading with education and providing a lot of really valuable and great, again, information regarding the real estate market. So you have access to this. It was completely free. It didn't cost anything but a little bit of time. It was maybe 1 or 2 nights that I ended up attending and got to ask him a host of questions that really helped and benefited me in the process. So what exactly did his sessions cover that were so important? I think there are a few things that are really empowering to any new, whether it's a purchaser or investor. So the first thing that Patrick did is he reviewed, specifically speaking, the demographic trends within San Diego. And why this was really important is because San Diego, if you think of just from a specific supply-demand dynamic, you have a limited supply constraint. So San Diego literally being kind of an island. We have the Pacific Ocean to our west. We have Mexico to the south. We have natural land that's preserved to the east with the mountains. And then we have Camp Pendleton to the north. So there's legitimate supply constraint. There just simply isn't much more land to build on. And yet with demand continuing to increase, that creates a dynamic here where normally, if you think of your supply demand curve, price would meet in the middle, and that would be where things would land. But in this case, if you have a distorted supply constraint and the demand is still high, naturally that gap is then getting filled with higher prices, right? Because of the demand being higher, people are going to be willing to pay more for that shortage in housing. And so it's really important to understand that. And what Patrick was able to then do was provide us with some visuals that basically supported the idea of about 16,000 units shortage per year was currently what they were experiencing. I believe that number was the one he cited. And so, that largely was now a backlog of multiple years of that having taken place. So kind of highlighting just some of the dynamics there, and then explaining how the demographics fit in. San Diego has, typically a lot of younger people are moving to the area. Obviously, it's a great lifestyle. So it's attractive, I think, from many people like myself from the East Coast. And just kind of working through, what those numbers looked like as far as population growth, trends and things like that was very, very helpful to understand. Because basically what you're trying to understand is, hey, is this scenario likely going to persist in the foreseeable future? Now, hopefully they, through regulation or whatever changes they can make, there's some ability to impact the supply constraint. But as of right now, it doesn't seem like that's going to be happening anytime soon. And with those continued favorable population trends, you would anticipate likely to see prices continuing to rise. So that was number one. Number two was a really helpful review of the economy. So with the San Diego economy in particular, it's a pretty resilient economy in the sense that there really isn't one major industry that does all the heavy lifting. So think, the auto industry with Detroit, for example. Meaning, if something specific were to happen to that industry, it could have significant spillover ramifications to the local economy, which in turn would impact the real estate pricing in that said economy accordingly. So that was another important piece to recognize. And so the dynamics of that were helpful in understanding the comfort level of actually investing in the San Diego real estate market, for example. All right, so the first thing was a lot of data and helpful information to support just that the trends are favorable as far as San Diego goes, right? There's a strong, resilient economy, a multi-sector economy, and there's favorable population trends. The next piece was really understanding where is your return likely going to come from when it comes to real estate. I think this is a really critical piece that a lot of people oftentimes overlook or really don't pay enough attention to. So it's helpful in just understanding whenever you're investing, there's two sources of return. There's the appreciation potential of the investment, and there's the income generating potential with the investment. And real estate is no different. So in that sense, you have the potential for appreciation or the potential for income along the way. Think about it nice and easy like that. Now, with San Diego, historically speaking, the appreciation rate has been 4.5%. That compares to 3% as the national average. So house prices nationally, Robert Schiller has provided a lot of data around this, basically returned about 3% per year, or increased about 3% per year, which is right in line with inflation. So really not wowing in that sense. Again, that's a national average. San Diego, again, going back to maybe some of these supply constraints, maybe desirability of living here with the coast, for various reasons has been about 4.5%. Interestingly enough, the other source of return, which is the income generating potential of your property, often called cap rate when you think of real estate. So we can just list that here as cap rate. And San Diego has also, this is just total coincidence, there's no real rhyme for that or reason for that, has also averaged about 4.5% similarly. So, when you combine these two, if you were to have a real, investment property specifically, you could basically say, hey, 9% is probably our hurdle rate of where we're thinking we'd be on average within the San Diego market. Different markets, 9% is fairly reasonable to think from an assumption standpoint. Different markets might get more of that return from their income generating potential, so high cap rate potential area, and maybe they have lower appreciation potential. So in particular for San Diego, for someone like me who was actually a little bit more interested in the appreciation potential at this stage, I thought that was a pretty good mix, and it seemed pretty attractive. So it was nice to understand that that was historically how that type of property has performed. Now, of course, what you then want to do is not just say, okay, it has performed that way historically, because past performance doesn't necessarily guarantee that it will continue that way, but it's helpful to benchmark. So then you can look within the neighborhood and the areas and start looking at comparables, price changes over the last few years, and see, does the data support what that historical trend has? And again, going back to the supply-demand constraints, the demographic trends, do you foresee that continuing into the future? So these are all the things to do up front that made us feel very, very comfortable moving forward with that purchase decision. And why I think this was so empowering was because, I mean, since if you think of it, everyone is always hoping to buy at the low point. And I think trying to time a decision like this where the numbers are so large, the purchases happen on such an infrequent basis. Oftentimes it could be for family reasons, growing a family, starting a family. There's a lot of things that go into the purchase process. Trying to time it can just drive you absolutely crazy. So what we basically came to the conclusion is, hey, we're not trying to buy at the bottom of the market, but if anything, we're a little bit more concerned with buying at a really high point in the market. And we wanted to have confidence and conviction behind our purchase decision that this was going to be something we'd be comfortable with 10, 15, 20, 30 years down the road even. So doing this homework in advance really did make us feel comfortable moving forward with that decision, because we felt like even though the market had, again, this was in 2019 when we had purchased it, even though the market had seen some serious growth, especially off of the 2009, 2010 lows, we still felt like there were favorable tailwinds behind us, and that, all of these things considered, that we could probably expect to see something similar in this source of returns on a go-forward basis. Now, in our case, and this is really important to distinguish between a home purchase and an investment property purchase. If you're just making a home purchase, you're really only seeing this appreciation potential because you're not going to be renting out the property to earn this income. So we actually purchased with the idea of, we'd probably be living in there initially with the potential to rent it out down the road. And so it was really important to us, and we told Patrick, the agent, that the property that we were looking for, while yes, we wanted it to be livable now, we wanted something that we felt like could be easily rentable down the road. So that was a big piece of it, which went into the analysis that we ultimately conducted. But it's important to distinguish that, because if you're thinking it's just going to be a forever home, this piece of the puzzle doesn't really fit in anymore. And so, maybe the appreciation isn't as important to you. Maybe the type of return isn't as important to you, but you wouldn't want to be baking something like this in if you were never planning on renting it out to begin with. Just an FYI. So, really important to consider was, again, what were the actual sources of return we could anticipate, and were the trends and different data available supporting that was likely to continue. To come back to this full circle on the story, so after the 2009, 2010 lows, again, it seemed almost like every year people were asking, is it too high to buy? Is it too high to buy? We came to the conclusion that we still felt comfortable, even if the market were to go sideways or even decrease for a year or two, long term, we would be pretty content with our purchase decision. Whether that ends up being the case or not, obviously we can't tell the future, but it did give us more conviction to move forward with, which ultimately I think is really the objective that we were looking to achieve here. So all of this happened before even figuring out how much house we could afford, what type of house we could afford, right? Really, we wanted to understand our local market and what was happening before jumping in and moving forward with that decision. Now, having had that conviction and understanding the different dynamics in play, that's when we went through and reviewed our numbers, understanding how much house we could afford. And so really, that's the sequence that you would typically want to go through, right? Get the information, attend a seminar like this, learn about your local real estate economy and everything that's happening there. Really, knowledge is power in that sense. Second step would be to meet with the financial planner, someone like ourselves, where it's, hey, how much house can we afford? How does it fit into our goals and objectives of what we're looking to achieve? The third step will tee the next conversation up really well, where you'll be meeting with the mortgage lender, who's typically going to provide the financing for you to buy this home. But now you can have such an easier conversation with them because you've already spoken with the financial planner about how much house you can afford and how it fits into your lifestyle. And then after you obtain the financing from the mortgage lender, you're going to go back to the agent with the dollar amount known in advance and say, this is how much house we're looking to buy. And you can feel like you're very much in the driver's seat in handling that. And they're going to be able to help you so much easier than if you go into it without knowing really what you can afford and have that financing ready and available. So if you go through this sequence, number one, you're going to save yourself time, you're likely to save yourself money, and it's going to be a lot more enjoyable and a lot less stressful of an experience. So I hope it proves helpful. If you've already purchased real estate and gone through something, I'd love to hear what your experience was like. Are you a first-time buyer? Have you purchased an investment property? Let me know, drop some information in the comments. And as always, if you have any questions, please don't hesitate to reach out. And if you need a financial planner to help you with this type of process, contact us, schedule that initial introductory appointment. I'd love to have a conversation with you. You can always reach us at drivenwm.com. All right, well, thanks for stopping by, and I'm sure we'll talk to you again soon. Be sure to check out some other videos if you haven't already.